$11,800. That is sitting in a buffer that most age pension recipients have never touched, never used, and in many cases never even heard of. And if you do a bit of work this year, a few shifts, some consulting, a market stall, anything that pays you an income, that buffer could be the difference between your pension staying exactly where it is and Centrelink cutting it back sharply. The stakes are real, and the window to use it is already open. Stick with me, because in the next few minutes I am going to show you exactly what this buffer is, how it works, and why so many pensioners leave it completely untouched. I'm Paul, and think of me as that mate who has spent way too much time reading Centrelink's fine print, so you don't have to. Here's what we're covering right now: what the work bonus actually is, how the balance builds up, and what most people get completely wrong about it. Right, let's get into it. The work bonus is a rule that sits inside the age pension income test. That's the test Centrelink runs to decide how much pension you receive based on what you earn. Normally, every dollar of employment income you earn gets assessed against your pension, and once you cross certain thresholds, your pension starts to reduce. The work bonus changes that equation. It says that a portion of your employment income simply does not count when Centrelink runs that assessment. It gets set aside, ignored, taken off the table. The income is still yours, you still earned it, but Centrelink acts as though part of it never happened. Here is the number that matters. Each fortnight, eligible age pension recipients build up a work bonus credit of $300. That credit accumulates in what Centrelink calls a work bonus balance. If you do not do any paid work in a given fortnight, that $300 rolls over and adds to your balance. Keep rolling, keep accumulating, and that balance can grow to a maximum of $11,800. That is the cap. That is the figure sitting there, potentially in your name right now, and it is not doing anything until you actually earn some employment income. When you do earn that income, the balance kicks in. Centrelink uses it to offset what you earned before they run their pension calculation. So if you pick up some casual shifts and earn $1,500 in a fortnight, and your work bonus balance is high enough to cover that, Centrelink may assess you on significantly less than the full $1,500. Your pension could stay completely intact or take a much smaller hit than you were expecting. Now here is the part that trips people up, and I want to be really clear about this because it causes genuine confusion. The work bonus balance is not money. It is not cash you can withdraw. It is not a top-up to your pension that Centrelink deposits into your account. It is a credit, an assessment buffer, a number that lives inside Centrelink's system and reduces the income figure they use when calculating your payment. Many people hear about the work bonus and imagine there is some pot of money with their name on it waiting to be claimed. There isn't. The value only shows up when you work, and it shows up as pension protection, not as cash in hand. And this brings me to the myth I hear all the time, said with complete certainty by people who are missing out because of it. The myth goes like this: if I do any paid work at all, Centrelink will find out, slash my pension immediately, and it will all be more trouble than it's worth. So I just won't bother. That thinking is completely understandable. The fear of getting something wrong with Centrelink is real, and nobody wants an overpayment debt landing in their letterbox. But that belief is costing people money because the work bonus exists specifically to soften the impact of earned income on your pension. It was designed to encourage pensioners to stay in the workforce a bit longer, to do some work without being punished for it. If you have a high work bonus balance and you pick up some casual work, the mechanism may protect your full pension payment, or close to it, depending on how much you earn and what other income you have. The key phrase there is employment income. The work bonus applies to income you earn from working, wages, salary, self-employment income from your own business. It does not apply to investment income, rental income, dividends, or your superannuation drawdowns. That distinction matters. If your income is coming from shares or a rental property, the work bonus does not shield it. But if you are getting paid to actually do something, to work, that is where this buffer comes into play. Let's put a real number on this to make it concrete. Say you have not done any paid work for 6 months. Your work bonus balance has been quietly building at $300 a fortnight. After 6 months, that is roughly $3,900 sitting in your balance. If you then pick up a one-off consulting job that pays you $3,000, Centrelink can offset that $3,000 against your balance before running the income test. Depending on your overall income situation, your pension that fortnight might not reduce at all. The $3,000 was earned, it was real income, and your pension absorbed it without a scratch. The rules do sound fiddly when you first hear them. There is a balance, a cap, a fortnightly credit, an offset. But the core idea really is simple once you know the numbers. You have a buffer. It can grow to $11,800. It protects your pension when you earn employment income. Most people have it, most people do not use it, and some people do not even know it exists. That changes right now. And just to be clear, this is general information, not personal financial advice. Your situation will be specific to you, so check your own work bonus balance with Centrelink or have a chat with a licensed financial advisor before you make any decisions. Now let's talk about how to actually use it without making a mess of things. Let me give you a real example, because this is where it all clicks into place. Meet Margaret. She's 68, lives in regional Queensland, and has been on the full-age pension for about 2 years. She does not work, her income is modest, and her work bonus balance has been accumulating quietly at $300 a fortnight without her even knowing. By the time her granddaughter asks her to help out at the family gift shop over the Christmas period, Margaret has built up a balance of around $7,800. She works 4 weeks, earns $3,200 in total. Under the normal income test, that employment income would get assessed, and her pension would start to reduce. But here is what actually happens. Centrelink takes that $3,200 and offsets it against Margaret's work bonus balance first. The assessed income from that work drops to zero. Her pension that fortnight? Unchanged. She earned $3,200, kept every cent of it, and her pension did not move. Her work bonus balance drops by $3,200, down to around $4,600. But it starts rebuilding again at $300 a fortnight from the moment she stops working. She is not penalised, she is not chased for an overpayment. She just earned some money. The buffer did its job, and life went on. Now let's say Margaret's situation was slightly different. Say she had already spent her work bonus balance down to zero, and she earned that same $3,200. The income test would apply in full. With the pension income test, once employment income exceeds the free area, the pension reduces by 50 cents for every dollar over the threshold. The exact reduction depends on her full income picture, but the point is simple. The buffer matters. A depleted balance and a full balance produce completely different outcomes from the same amount of work. Here is the detail most people miss entirely, and it genuinely catches people out. The work bonus credits are applied in the same fortnight the income is assessed. This means timing and reporting matter more than most people realise. If you earn income in a given fortnight, you need to report it to Centrelink for that period, and the offset happens in that assessment cycle. If you delay reporting or report income in the wrong period, the credit may not line up the way you expect. Centrelink assesses each fortnight on its own terms. Get the reporting right, and the buffer works cleanly. Get it wrong, and you can end up with an unexpected reduction or worse, an overpayment you then have to sort out. Report your income accurately, report it on time, and the system works the way it is supposed to. Right. 3 steps. Simple, numbered. Do them in order. Step 1. Check whether you are actually on an eligible payment. The work bonus applies to age pension recipients and also to some other qualifying income support payments. Log into your MyGov account, find your Centrelink information and confirm you are on the age pension. While you are in there, look for your work bonus balance. Centrelink does display this, and knowing your current balance tells you exactly how much employment income buffer you have available before your pension is affected at all. Step 2. Check your reporting setup and understand what counts. Make sure you know exactly how you report employment income to Centrelink, whether that is through the Centrelink app, online, or by phone. Confirm that any income you are planning to earn is actually employment income, wages, salary, or self-employment from your own work, because only that type of income triggers the work bonus offset. Rental income, dividends, and super drawdowns do not qualify. Know the difference before you start working, not after. Step 3. Confirm the effect on your specific situation before you act. This is the step people skip, and it is the one that matters most. Talk to Centrelink directly or sit down with a licensed financial advisor who understands the pension income test. Your full income picture, including any other income sources, your assets, your partner's situation if you have one, all of it affects the final pension calculation. The work bonus is one piece of that puzzle. Get the full picture confirmed before you start work, so there are no surprises. And just to be completely clear, nothing I have shared here is personal financial advice. This is general information designed to help you understand how the work bonus works. Your circumstances are yours alone, and the right move is to check the specifics with Centrelink or a licensed advisor before making any decisions. So here is the takeaway, and it is a simple one. You may have up to $11,800 sitting as a work bonus buffer right now. If you do some paid work this year, that buffer could protect your pension entirely or dramatically reduce the impact on it. But only if you know it exists, only if you understand how it works, and only if you report your income correctly and on time. This is a genuinely valuable mechanism that most pensioners never use simply because nobody told them about it. Now you know. If this helped you today, do me a favour and subscribe. I put out videos every week breaking down exactly this kind of thing. Real numbers, real examples, no jargon. Drop a comment below and tell me whether you knew about the work bonus before today. I read every single one, and it helps me know what to cover next. I'll see you in the next one.